Logged in now. Advanced taxation. So yesterday we discussed that in ATX, you guys are supposed to mark a total of 6 papers. Uh, I can share now again which 6 papers are advisable. ATX December 23, June 23, September 23, uh, March June 22, September December 21, September December 22 is not advisable. Then practice exam 1 to 3 is advisable. Specimen is somewhat which is like based on the previous Finance Act, not based on the current Finance Act, hence it is not advisable. So if you can see, I haven't started any of the paper, whereas one paper is on resume for me, not something to start. So the resume thing reflects that it is something which I was doing yesterday, but unable to complete that, and hence will be doing it today. Okay. So moving forward, next. So we did the first question yesterday, and today we are going to start the question based on section B. This section of exam contains 2 questions. Each exam, each question is worth 25 marks and is compulsory. The exam session is worth 50 marks in total. You should assume that the tax rate and allowances for 22-23 and for the financial year to 31st March 23 will continue to apply for the foreseeable future unless you are instructed otherwise. It means if nothing mentioned, you should assume that the tax rates for this 22-23 will remain same. Calculations and workings only to be made to the nearest fund. All apportionment will be made to the nearest one in your live exam. You should enter your answer in response, indicate which requirement. Okay, so you should assume that today's date is 1st June 2020. The finance director of Evora Limited has requested advice on the following. The tax implications of acquiring 2 assets from an unincorporated business, commencing trading activities overseas, and the VAT consequences of purchasing goods and services from overseas. The exhibit available on the left-hand side of the screen provides information relevant to the question. Evora Limited. This information should be used to answer the requirement chosen response. Requirement I will read it later on. Evora Limited and Silves Limited. Evora Limited owns 100% of the ordinary share capital of in Silves Limited. Fine. Evora Limited and Silves Limited are both UK resident trading companies. Both companies prepare accounts to 31st March each year. Fine. Silves Limited acquisition of assets from an unincorporated business. On 1st April 22, Silves Limited acquired the following assets from an unincorporated business. Cost to Silves Limited, Elt Brand 50,000, Specialist Machine 30,000. Silves Limited is using both of these assets for the purpose of its trade. Fine, both of these assets are acquired for the purpose of trade. The Elt brand will be amortized on a straight line basis over an 8-year period. The Specialist Machine was previously used by an unincorporated business in its trade. S Limited will adopt the most tax efficient treatment, which is favorable for these assets. Evora Limited trading overseas. On 1st July 23, Evora Limited will start trading in the country of Selma. Evora Limited has been advised that it will be advantageous for tax purpose to operate through a permanent establishment in rather than a subsidiary incorporated and tax resident in Selma. The overseas operations will be loss-making for the first 9 months of trading, after which it is expected to be profitable. Evora Limited will take tax relief for the loss incurred. Evora Limited will take relief for the loss incurred by its operation in Salima as early as possible. Means carry forward is something which would be the last option. First priority would be current year carry back type of stuff. Evora Limited has currently no other overseas operations but plans to open additional permanent establishment overseas within the next few years. Fine. The tax system in Salima. The rate of tax on the profits of permanent establishment in Salima is 28%. There is no double tax treaty between UK and Salima. Fine. Forecast trading results. Evora Limited, UK operations year ending 31st March 24, trading profit or loss. Salima operations period ending 31st March 24. Silves Limited year ending 31st March 24. Fine. Neither company has any other source of income or gains. Evora Limited VAT. Evora Limited is registered for the purpose of VAT in UK and makes fully taxable supply. In April 23, Evora Limited engaged the service of a legal firm in Salima, to which it paid a fee of 3,500 in the last same month. In May 23, Evora Limited purchased goods from a supplier in Salima, costing 2,100 for sale in its UK operation. So it's basically last two lines gives me the message like there is a purchase of goods from overseas, and secondly, there is a purchase of service from overseas. So yeah, that's Very honestly, a pure and a great corporation tax related question. I would not say covering many aspects of corporation tax, but mainly focusing on the overseas aspects relating to the corporation tax. You should assume that today's date is 1st June 23. Explain the corporation tax treatment for S Limited in the year ending 31st March 23 in relation to the acquisition of the two assets. Explain by reference to the reliefs available for the forecast trading loss why it will be advantageous for Evora Limited to commence trading in Salima through a permanent establishment rather than overseas subsidiary company. Why it will be advantageous. So one thing is for sure that it will be advantageous. We just need to comment, we just need to talk why it will be advantageous. You should assume for this part that Evora Limited does not make an election to exempt the profits of its permanent establishment from UK corporation tax. State the consequences for Evora Limited of making an election to exempt the state the consequences for Evora Limited of making an election to exempt the profits of overseas permanent establishment from UK corporation tax and advise such company whether or not it will be beneficial to make this election on the basis of the company's current forecast results on the basis of company's current future results and its future plans. Explain how the following items will be reported on VAT return for the quarter ended 30th June 23. The services purchased, from the overseas uh, legal firm and goods acquired from the overseas supplier. State, okay, perfect. Professional marks should be awarded for demonstration of analysis and evaluation, commercial acumen, and skepticism in your answer. Anything majorly you want to comment before I start the answer, before I start writing the answer, discussing the answer? So anything you like to share your thoughts, your feedback on this? Waiting to hear from you. Mm. Perfect. So, to me, it's always sounds like it's better approach that you start your answer on the Word document and refer to the workings at the spreadsheet. Okay. So I'm going to start my answer on Word document and will keep referring at the spreadsheet. Now, let me read the first requirement again. Explain the corporation tax treatment for uh, Sil Silps Limited in the year ending 31st March 23 in relation to the acquisition of each of these two assets. Hmm. Corporation tax treatment in the year ending. Corporation tax treatment in relation to the acquisition of each of these two assets. So heading format, I put the heading format as bold underline, and this is my main heading format, right? The two assets were, the first one was alt brand and second one is specialist machine. Yes, alt brand. The amortization charged in sales limited accounts will be an allowable deduction of the acquisition took place on 1st April 2022. Since acquisition took place on 1st April 2022, hence 50,000 divided by 8 6250 in the year ending 31st March 2023. Since It was acquired on 1st April 2022. Hence, there is no need of month apportionment. So, no discussion about month apportionment. The alternate option for sales limited would be to claim annual allowance at 4% on straight line basis. Using the default specialist machine. Uh, the acquisition of machine would annual investment allowance at 100%, in which for a 12-month period of up to 1 million in which the machine is acquired. Enhanced capital allowance as machine is not new. So I hope you understand that enhanced capital allowance is only available on the purchase of new assets. So enhanced capital allowance is not applicable on the purchase of second-hand assets. The limit of 1 million applies to group of companies. So if total qualifying assets acquired by the two companies exceeds this limit, need to use the AIA allocation strategy. To maximize the AI. So, any part of the requirement which is not clear from both the uh, alt brand and specialist machine? Thank you, Madeline, for the feedback. So, anything, Mabel, from your side? You like to add anything? You like to ask anything? Perfect. Let's move forward to the part B. Explain by reference to the reliefs available for the forecast trading loss, why it will be advantageous for to commence trading in Salima through a permanent establishment rather than overseas subsidiary. So, tax advantages of commencing trade in. So, honestly, this is a pretty much a straightforward requirement where there is no, but you just need to be careful. You just need to be vigilant that currently the situation is of loss making. So keep the loss making situation in mind and start commenting the answer. A permanent establishment does not constitute a separate legal entity. unlike a subsidiary company. Any loss in the first 9 months of trade can be adjusted against of Evora Limited. Hence, immediately obtaining however, cannot be adjusted in UK. Medellin, exactly. So your just one word, I expanded that one word and elaborated into 2 to 3 points to at least, justify my marks. So if I'm not wrong, there was 3 marks allocated to this requirement. So I need to justify the 3 marks. B, state the tax consequences of making an election to exempt the profits of permanent establishment from UK corporation tax. First consequences and advise the company whether or not beneficial to make. Tax consequences of making an election to exempt the profits of overseas permanent establishment from UK corporation tax. So this requirement essentially is divided into two parts. The first part is on tax consequences and second part is on advice. So this is again in general, nothing you can say very much scenario specific, right? Trading profit generated in overseas permanent establishment will not be liable to no relief will be available in the UK of trading losses incurred in no capital allowances can be claimed in the UK in respect of assets acquired the election is irrevocable. To all overseas permanent establishments Yes. So, what advice do you make to Evora Limited? Yes. What advice do you make to Evora Limited? Whether Evora should go for the uh, election or whether Evora should not go? Okay. A valid point, Madeline. Any further feedback? Fair thing. DTR would be available. Any further comment that these points are valid? Nabil, anything from your side? Perfect. So before I write, let me give you my perspective. What Evora Limited can do. Initially, there is a profit, and later on, there will be, sorry, initial there is a loss, and later on, there will be a profit. So, one possible advice to Evora could be Evora, uh, do not make this election in the first year. Make this election once the permanent establishment becomes profitable. Because, once it becomes profitable, then making the election makes sense. Means then you are not supposed to pay the tax on your branch profit. But if you make the election today, you will lose the loss relief which we were referring. So at the moment, there is a loss of 240, which can be adjusted in current year. Loss relief would be claimed in current year. Is this thing bit clear or makes sense? So let me start writing the answer on this. There is clear no advantage to Evora Limited of making this election at this point, as the permanent establishment and will generate the loss in its first 9 months of trading, which can only be if branch when the permanent establishment in Salima is subsequently becomes profitable, There will be no UK tax on the due to availability of this is because that this is because the tax in Salima is higher than the so I hope you understand. I'm like there will be no impact because the tax rate in Salima is higher, hence the UK tax will be automatically fall under the ambit of DTR. In addition, the election will prevent UK capital allowances used in any overseas permanent establishment. And no loss relief in respect of therefore the exemption election does not sound to be Or is the advice part clear, or do I need to elaborate it more? Thank you, Madeline. Mabel, what about you? What's your feedback? Perfect. So going to start the last part, which is around the VAT. Explain the following, how the following items will be reported to Evora Limited VAT return for the quarter ended 30th June 23. Yes, so the first was overseas fee. Limited is registered for VAT purpose in the UK and makes solely taxable supplies and makes solely taxable supplies. Fine. In April 23, Evora Limited engaged the service to which it paid a legal fees of 3,500. In May 23, Evora Limited purchased goods from a supplier costing 2,100 for sale in its UK operation. So services purchased. The legal services provided to Evora Limited will be regarded as being supplied in UK accordingly. Evora Limited will be required to account for VAT it can then recover as input VAT Therefore, this expense will not impact the amount payable Therefore, this expense will not impact. Fine. This is the one discussion. The second is the goods acquired. On the assumption that Evora Limited uses accrual basis same as legal firm service. Therefore, this expense will also not impact the amount of VAT payable impact by Evora Limited. So, I'm done with the wet part as well. Anything in the meanwhile you want to ask? Evora Limited. Yes, so anything to ask from Evora Limited further? So perfect, Madeline, no worries on that. So Madeline, on this front, basically, since goods purchase, so at the moment your question is more on the goods or is your question more on the service or both? Goods, perfect. For goods, when the goods are purchased, it is considered as purchased in the UK. And like if you purchase in UK, you would have paid back to HMRC via your supplier. Since here the supplier is based out of UK, hence you are unable to give any VAT to the HMRC. Hence, it is assumed an output VAT because it's like rather than via supplier, you are directly supposed to pay the VAT to HMRC. Later on, like as always, you can recover the same as your import VAT. As always, you can recover the same as your import VAT. And based on this, again, as always, VAT would remain either payable or receivable, asset or liability, neither income nor expense. Is it done? Madeline, I don't know, luckily, unluckily, in most of the jurisdictions across the world, export is zero rated. So for UK, it is import, and for uh, Salima, it's export. And normally exports are always zero rated. In UK as well, the principle is same. If you make any kind of export, that is zero rated. Is it fine? Perfect. Um, Let me move ahead. So anything from your side, Mabel? Is it good to move? Perfect. Thank you, Mabel. Moving forward to the next question. The next question is Anya. Uh, Let me start discussing this question, like what this question is about, what are the key takeaways, what are the key discussion points in this question. Anya requires advice on the capital gains tax and inheritance tax implications of a gift of painting. So the first I can tell it's gift of painting, and somewhat we are supposed to discuss the IHT and CGT implications of this. The CGT and IHT reliefs available on the gift of shares. Second, the impact of post-tax income of the gift of shares. So there would be some gift of shares, and you are supposed to calculate its post-tax impact. Interestingly, if you notice in the previous question, Evora Limited, there was no single use of calculation, right? Anya is tax resident and domiciled in UK. You know, very interestingly, whenever this kind of a statement is given, Anya is resident and domiciled in UK. It means Anya is a person who has to pay UK income tax on its worldwide income, worldwide gains, UK IHT on worldwide assets. So this is the brief consequence. Has never been married or in a civil partnership? Fine. Has one daughter, Kara, and two granddaughters, Flava and Violet. All of them are tax resident and domiciled in UK. Has made one previous lifetime gift on 31st March 22. She gave Kara an investment property valued at 390. You should assume that Anya will die on 6 September 2024. Sorry. Anya proposed gifts. Anya is proposing to make the following gifts: 50,000 cash to Flava on 1st July 23, a painting to Violet on 1st August 23, all of her ordinary shares in Chasky Limited to Kara on 1st September 23. Proposed gift of painting. Anya purchased the painting on 8 July 2008 for 104,000. The value of painting on 1st August 23 will be 63,000. Fine. So if I look purchase for 104 and painting purchase for 104 and its market value is 63,000, right? Proposed gift of shares in Chasky Limited. Anya acquired 100% of the ordinary shares capital in Chasky Limited on 1st May 2009. Chasky Limited is an unquoted trading company. The market value of the assets owned by Chasky Limited will be as follows. Land building equipment, 2% shareholding in RQ Limited, inventory and cash. So RQ Limited means I can see some of the non-business assets in the Chasky Limited. Anya has gross annual taxable pension income of 65. The word is taxable pension income. Taxable pension income means this figure is somewhat like after deducting personal allowance. Uh, Source of income, dividends. Chasky Limited paid a dividend of 40,000 in respect of its ordinary shares. Will pay a dividend of 34,000 on 13 January 2024. Fine. So anything which is like from a scenario perspective, not clear in the question. Okay, let me read the requirements. Explain the capital gains tax and inheritance tax implications of proposing the gift of painting to Violet on 1st August 2003. Fine. So CGT and inheritance tax implications of the proposed gift of painting to Violet. Yes, if I ask you one by one, what will be the implication? Uh, Fall in value relief for IHT. I hear you. I noted your point. I will respond on this fall in value relief aspect when I will be on CGT. But at the moment, I'm starting my conversation on the capital gains. So, with respect to capital gains tax, if I give a very sweet and simple bullet points, like pointers, you can say. The first pointer is the disposal will be recorded at market value. Second, the disposal will be recorded at market value. Second would be, I agree, for CGT market value will be used. Uh, After that market value element, since the cost was more than the market value, hence there will be a loss. Um, would there be any gift relief type of discussion? Just asking. Would there be any gift relief type of discussion over here? Any gift relief type of discussion over here? Mabel, Medley, would there be any gift relief type of discussion? If anyone of you believe no, then do let me know why not. And if yes, then why? Like either. Why no gift relief? So I hear you that there will be no gift relief, but why there will be no gift relief? Very sweet and simple, dear. Because like for gift relief, the asset two conditions. Both should agree to claim the relief. And second important condition is the asset should be business asset. So is the asset is a business asset? If the answer is no on this front, the business asset front, very clearly there will be no gift relief type of thing. You're most welcome. So I hope the explanation really helps you. Let's start the capital gains tax implication in a formal way and a proper way, right? The disposal will generate a capital loss of 41,000 calculated as Violet is Anya's granddaughter. So is a connected person. Gift relief would not be available on painting as painting is not a yes, with respect to inheritance tax. The gift of painting would be potentially exempt transfer for IST, which will become chargeable as a result of Anya's death. And we are supposed to assume that Anya will die on if I look proposed gifts 1st July 23, 1st August 23. Annual exemption would not be available as these will have been used on the cash gift to Lava. $50,000 cash gift to Flava on 1st July 2023. No nil rate band. No nil rate band at time of death will be available, as it will be used against the gift of investment property to Tara on 31st March 2022. No taper relief will be available, as Anya death occur between within 3 years of the gift. Accordingly, the gift of painting will give rise to NIHT liability of 63,000 multiplied by 40%, which will be payable by Violet. Kindly do confirm the calculation, please. So I made a verbal calculation, but do acknowledge is this correct or not? Second, in relation to Anya proposed gift, oh, by the way, I apologize, I missed to discuss. So there was one comment about fallen value relief. Why not I considered fallen value relief? Why not I talked about fallen value relief? Please remember, fallen value relief, the concept of fallen value relief applies when I have gifted the asset and the gifted asset falls in value. So here, Anya acquired the asset for 103, and when she was gifting the asset to Violet, its value was already 63,000. So if you ask me, is there any fall in value? Technically, yes, there is already a fall in value. I would not deny with this fact, but is it something which triggers the fall in value relief element? The answer is no. Madeline, this was purely for you, and I hope you understand the discussion around the visibility of this relief. Uh, again, Madeline, is that discussion around non-availability and when slash where to talk about fallen value. More important. Is this thing clear to you? Or is this discussion bit not clear to you? And if not, I don't mind having it again. Availability of gift holdover relief. Thank you, Mabel. Thank you. Advice on the availability of gift holdover relief. So, Mabel, for gift holdover relief, there are two main conditions. First, the asset should be business asset. Second, the gift or giftee transfer or transferring should agree to claim the relief. Right. So these two are the main conditions. If you ask me over here, I really don't know about the consensus of claiming the relief. But before I talk about the consensus element, I know one thing already for sure that painting is not a business asset at all. Hence, I am like irrespective of the consent and it's and for these conditions, it's not or for these conditions. Perfect. Advice on the availability to Anya of gift holdover relief. This is advice on the availability of gift holdover relief, and this is with respect to Chasky Limited shares. So I need to look for the Chasky Limited details. Uh, Anya acquired 100% of the ordinary shares in Chasky Limited on 1st May 2009. Chasky Limited is an unquoted trading company. The market value of the assets owned by Chasky Limited will be as follows. Fine. The gift of shares in Chasky Limited will be eligible for gift holdover relief as Chasky Limited is an unquoted trading company. Since Chasqui Limited owns RQ Limited shares, which are not a business asset for Chasqui Limited. Hence, gift holdover relief would be with reference to the shares in RQ Limited, which are not chargeable business assets. The proportion of gain which will be eligible for gift holdover relief will be calculated as the value of chargeable business asset divided by chargeable asset accordingly. The proportion of gain which qualifies for relief is 853 divided by 853 plus 60,000. Because inventory and cash, it's not a chargeable asset. Equipment, it's not a chargeable asset because equipment is like vesting capital, which is exempt from capital gains. Hence, I have not considered these two assets. Can you please tell me help me in the calculation? Any one of you, please help me in the calculation. I really don't want to, I'm really not interested to use the calculator. Rather look towards you guys for your support. It's 91300. Shouldn't it be in percentage? 93%. 93%. Can you tell me in one decimal, please? So I hope it's not, to be exact, 93, right? 93.4. Perfect. So this is the discussion on the relief. And second one was consequence for Kara of this, of claiming the relief. Consequence. When Kara subsequently sold these shares, her base cost will be reduced for by the amount of gift holdover relief due to which gain on sale of shares would become higher for Kara. Since Anya will die on 6th September, the IST will then be due on this gift. Advice on the availability of business property relief in calculating the IHT liability of the gift as a result of Anya death, and any additional conditions for Kara attaching to this relief. availability of business property relief in IHT, and yes, so what are the IHT reliefs available? First of all, business property relief, BPR, will be available at the rate of 100% as Chasky Limited is an unquoted trading company and Ania have held the shares for more than 2 years prior to the date of however, the fact that Chasky Limited assets include shares in RQ Limited, which is not a business asset. BPR would be reduced accordingly. The BPR would be restricted to the proportion of market value of business asset to market value of total assets accordingly. The relief available will be $1,034,000 minus 60,000 Can you please tell me the answer again? Can you please tell me the answer? Kara must still hold the shares or relate hmm, or related business property. Can you please tell me on one decimal? $94.2. Thank you, Madeline. Much appreciated. And the shares must be otherwise the BPR would flop out. Um, Anything which is like not clear or requires clarification slash explanation. Till part B, anything which requires explanation, clarification. Anything to ask? I want explanation the chattel less than 6,000, but then I agree. So chattels are exempt by default. If sold at profit, then it has a capital gains consequences. If sold at loss, there is no consequence to the capital gain. So is there any clue or can you conclude that it's being disposed of at profit? Exactly. So my discussion is on these lines to be precise. Let me open up that particular area. No item worth more than 6,000. So it means all items have worth less than 6,000. And if all items have worth less than 6,000, then it is low value chattel. Uh, so is it clear? Exactly. So no item worth more. So probably, I'm just thinking loudly, it means that they would have 15, 20 items which are we it means that there are somewhat 15, 20 items of the equipment. So it's not one line item of equipment. So it's not only one item as equipment, there would be multiple items. Did we consider it as a part of gift holdover? The answer is no, because if you notice, we have considered uh, that's why uh, we not considered this in the calculation of chargeable business asset to chargeable asset. Um, Madeline, does it clarify your query? Okay. Let's start with part C of the requirement. Calculate the reduction in Anya post-tax income for the tax year 23-24 as compared with the tax year 22-23 on the assumption that she gives all of her shares to Kara as planned. So you are supposed to calculate the reduction in post-tax income with respect to 23 versus 23-24 on the assumption that she will transfer the shares. If she will transfer the shares, the income will not belong to her. If income will not belong to her, there will be reduction in income tax liability. And what will be the revised income tax liability? So this is a summary of the requirement. Very honestly and independently, this requirement is not very much difficult. This is a pretty much simple requirement which you guys would be used to of looking at times of losses type of discussion. Okay, so with this background discussion, let me start the question. Uh, So, reduction in ANIA post-tax income for the tax year 23-24. Refer working one. So, I am supposed to calculate 22, 23. Fine. 40,000, 34,000. First one is pension income, 65,000, 65,000. After pension income, dividend income, 40,000 over here, zero over here. Personal allowance. I hope you understand this working. Please do acknowledge me. If you understand, if you do not understand, in both the situations, please do acknowledge me. Thank you, Mabel. Madeline, do you understand this working? the 40,000 dividend, of which 1,000 is exempt. Reduction in post-tax income. Five, let's call it as it create. Reduction in post-tax income would be by 25838. Are you comfortable now? So I'm done. Is there anything in particular you guys want to ask from the question? Medal, sorry, link, yes, for sure you can. What I can do is I can take the PDF, I can download the question as PDF, export it to PDF and share it with you, whatever we have solved. So you can, if you want, you can take the screenshot. You want the screenshot of, uh, so drop me a WhatsApp, I will share with you. Drop me the WhatsApp in your group. I will share that with you immediately after the class. No worries. Yes, anything in particular, anyone of you want to ask, anyone of you, anyone of you want to discuss, please do let me know. Else, I'm done from my side for the day. Yep, my friend. So if you noticed here, uh, it's B5 minus 1000. So 1000 is basically for the exemption. Perfect. Thank you for joining today. I hope I tried my best to make the best use for you guys of this time, and I'm successful in that. And that's my assumption, whether I'm not or not, whether I'm able or not, you guys are in a better position to respond for that. Nevertheless, thank you once again for joining. Take care. Feel free to reach out for any queries if you have. I would be happy to answer. Once again, thanks. Good day. Bye. Uh, Mabel, let me share with you. No worries. So you can drop me the message directly. I'm typing it for you. Perfect. So do note this number. Drop me WhatsApp. I'll share these files with you. Nothing to worry around. Uh, Madeline, so very honestly, every single person appearing in TX or ATX is my student. Whether he or she is studying from me or not, that really doesn't matter. So more than tutor, I like myself to be called as mentor for TX and ATX. And for me, again, it really doesn't matter whether he is studying from me or not. He's TX, ATX student. I and that particular student is on one agenda platform to pass this paper. That's it. So, and I hope Mabel, Madeline, I don't know, you guys have the latest summary notes or not. If not, do ask for that as well so that I can share the summary notes as well. So the summary notes are like 40-pager notes, uh, great for the revision, not for the concept building, please, but great for the revision. So I'll share that as well. Well, again, time to say goodbye from my side. Take care. Thank you very much. Keep remembering your prayers, Mabel. Much appreciated for your prayers. Thank you. Goodbye.